If you are a broke college student who received zero financial education from your parents, the only question that might bother your mind is, how on earth do these rich people make billions of dollars? The housing market is set to collapse, the stock market is falling, and the Fed is hiking interest rates, but Bernard Arnault made $32 billion. We imply that we would be the happiest people on earth if we could earn just 1/10 of that much. The equivalent of $320 million is even 1% of that sum. With that type of money, not just you but also your children, grandchildren, and anyone else can buy practically whatever they desire. Congratulations, you have infinite money. Nobody will at least be poor in the next 3 or 4 generations in your bloodline. So bottom line, how exactly can you get that much money? Hey, welcome to Stock Market Mate. Today we'll talk about the top 5 biggest investing mistakes that Warren Buffett wants you to avoid. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Number 5. Not developing a proper saving habit. The single biggest error that most people make, in the opinion of Warren Buffett, is not developing a proper saving habit. Everything boils down to this. Even though it seems boring and you've probably heard it a million times, no matter how much money you earn, if you can't cut the habit of not saving, you'll always be poor. Every time we speak to someone who makes significantly more money than we do, they always whine that they can't afford this or that. They're concerned about potential job loss or a downturn in the economy. The only thing we want to know is, what in the world did you do with all the money you made over the last 5 years? If you had saved that money, you would have been okay no matter what transpired. But instead, you gave into your desires and purchased expensive items that are now worthless. It's really easy to get wealthy, as demonstrated here. When you have carefully saved enough money to cover your essential expenses, you're financially independent. Now that you have more money, you can afford to do whatever you want. You have no obligations, no supervisor to answer to, and are compelled to waste your time on activities that won't make you happy or earn you more money. You will therefore make millions, if not billions of money from there. But unless you develop the practice of saving money, it won't happen. Number 4. Trying to time the market. Trying to time the market is the second error that most individuals make. Some of these 20-year-old youngsters who only have a few $1,000s saved up are attempting to time the market and make millions of dollars. However, we will caution you against even considering doing this. They disregarded the first piece of advice, which was to keep costs down. Do not risk that money, please. Building capital is your responsibility, not tinkering with it or trying to time the market. We made this error several times when we initially entered the stock market. We have lost a lot of money even though we did make some. The question then becomes what kind of equities you should purchase. Number 3. Investing in stocks or businesses that you don't understand. According to Buffett, don't even consider buying a stock for 10 minutes if you aren't thinking about owning it for 10 years. People today spend their entire life savings on things simply because they're popular, simply because something is hip or trendy. Just consider how you might possibly invest in something you know so little about when you have hardly enough money saved. Have you read the company's financial statements? Have you examined the income statement for it? Have you checked their cash flow recently? Do you know how the business intends to expand over the next 5 or 10 years? Despite not having done any of those things, you might still choose to stake your entire life savings. The majority of people lack the ability to foretell the upcoming teenage fashion fad or whether a new treatment will be a commercial success. Even if you had access to more data than anyone else, you couldn't reliably foresee the future. Buffett cautions against investing in circumstances where a precise future projection is necessary. Simply search for other firms to invest in if it's too complicated for you. Before even considering valuation, Buffett once stated that he would only like to invest in a small number of the approximately 10,000 plus publicly traded companies. Sometimes we're eager to invest in our money in something we have little knowledge of, and then blame everything on Wall Street. Where was your due diligence? Therefore, before making any investments, ask yourself if you have the confidence to keep them for a decade. Be it a company, estate, stock, or cryptocurrency. In 9 out of 10 situations, the response will be no. So trust us, you're going to save money if you avoid stocks or businesses you don't understand. Number 2. Having debts. The following advice is straightforward, but people consistently fall for it. Avoid debt at all costs. Debt can be quite beneficial in some circumstances, but many people lack the self-control necessary to manage it. Leverage provides you with all these alternatives, yet many people really lose everything because their plans didn't work out as they expected. That single trade or deal ruined any wealth they had left because they have leveraged their positions. If you're clever, you can make a lot of money without taking out debts. We haven't even mentioned the credit card debts. The interest rate on credit card debt may be much greater than that. The average credit card charges roughly 15%. Which may cost you a lot if you consistently skip payments or just pay the minimum amount due each month. Today, the typical household with revolving credit card debt pays roughly $1,000 in interest annually due to the many people who fall into that trap. There are 2 popular ways to tackle debt: the avalanche method and the snowball method. The debts with the greatest interest rates are paid off in order of priority using the first method. With the second, you concentrate on paying off the lowest bills first to build momentum. Once you're debt-free, develop the habit of paying off all your obligations so that you never again have to pay interest. Number 1. Not investing in yourself. Generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents. Nobody can tax it or take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen. But if you've got talent yourself and you've maximized your talent, you've got a tremendous asset that can return tenfold, says Buffett. Millions of people who have discovered that success can be attained by making wise financial decisions have become Warren Buffett's fans. However, those choices might not be related in any way to stocks and bonds. The most important lesson to be learned from the Oracle of Omaha may be this one. Making the most of your investment requires continuing to learn things that will benefit you not only as an investor, but also as a full person. Charlie Munger, Buffett's business partner, had a similar idea. Munger's golden rule for success is to devote an hour a day to improving oneself. The key to success and applicable to more than simply investing is to invest in yourself. 75% of Americans, according to Paid Surveys USA, invest in themselves first. Well, that's about it for today's video. We hope you enjoy these investment tips from Warren Buffett, which can be followed by almost anyone to be a successful investor. Let us know your thoughts in the comments section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you in the next one.
If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!